Understanding the risk-reward ratio, a key to smarter investing. The risk-reward ratio is a way to measure how much potential profit you can make for every dollar you risk on an investment. It's a simple calculation that can help you make more informed investment decisions. Here's how it works. Determine your potential loss. This is the amount of money you could lose if the investment doesn't go your way. This is often determined by where you place your stop-loss order, which is an order to automatically sell your investment if it drops to a certain price. Determine your potential profit. This is the amount of money you could make if the investment goes as planned. This is often determined by your price target, which is the price at which you would sell your investment to realize your profit. Divide your potential profit by your potential loss. This gives you your risk-reward ratio. For example, let's say you're considering buying a stock that's currently trading at $100 per share. You believe the stock has the potential to go up to $120 per share, but you also want to limit your potential loss to $10 per share. Potential profit, $120 minus $100 equals $20. Potential loss, $100 minus $90 equals $10. Risk-reward ratio, $20 divided by $10 equals 2. This means that for every $1 you risk, you have the potential to make $2 in profit. Here's another example. You're thinking about investing in a new cryptocurrency that's currently trading at 50 cents per coin. You think it could go up to $1 per coin, but you're also worried it could drop to 25 cents per coin. Potential profit, $1 minus 50 cents equals 50 cents. Potential loss, 50 cents minus 25 cents equals 25 cents. The risk-reward ratio, 50 cents divided by 25 cents equals 2. Again, this means that for every dollar you risk, you have the potential to make $2 in profit. Interpreting the risk-reward ratio. A higher risk-reward ratio generally means that the investment is riskier, but it also has the potential for greater rewards. A lower risk-reward ratio generally means that the investment is less risky, but it also has the potential for lower rewards. There's no right or wrong risk-reward ratio. The best ratio for you will depend on your individual risk tolerance and investment goals. Here are a few things to keep in mind when using the risk-reward ratio. It's just one factor to consider when making investment decisions. You should also consider other factors, such as the company's financial health, the overall market conditions, and your own personal financial situation. It's based on your own estimates of potential profit and loss. These estimates may not be accurate, so it's important to be realistic and to use conservative estimates. It can be used for any type of investment, including stocks, bonds, options, and cryptocurrencies. By understanding the risk-reward ratio, you can make more informed investment decisions and improve your chances of success.